Welcome everyone. All we know, the world economy has entered the era of low interest rates, and the income of Chinese assets has obvious advantages on a global scale. China has opened up for foreign capital markets in order to bring more money flowing in and out of the country. However, data shows that the foreign capital still has concerns about entering the Chinese financial markets, especially the bond markets, such as is always maintained only the purchase of treasury bonds and is not the expectation from the market. So, what are the factors or any hidden barriers that make Wall Street money to jump into the China credit markets? Is Wall Street ready for China access? Today, we are so happy to have three guests here to talk about this topic.
I would like to add some information about the Chinese local bond market. Okay, so the first point I would like to say is that the Chinese local bond market, the yield of our local bond is very high. It's compared higher than the international market. That's the first point. The second point is that the interest rate spread between China and some developed market like US is on the historical highest spread level till now. The spread between the 10-year government bond between China and the US is above 250 bips till now, which is the highest among the past 10 years. The 10-year average spread between the two countries' 10-year bond is only 130 bips. So that means the Chinese government bond is quite attractive till now, right? And the third point I would like to add to some investor to observe is that there is a trend that the international government bond or bond index like Barclay Index or Russell Index, etc., many of the very international welcomed bond index are beginning to include the Chinese government bond as one of the important portion of the index component. So till now, the international investor only 10% of our local interest rate bond market. So from maybe beginning from this year to in the near future, I think, based on the index include our local bond market into the index, there is we can see in the near future the portion of our government bond to be bought by lots of the international investors. I think the portion will rise to maybe 20% in the near years, I think. And the third point I would like to say is that the default rate of our Chinese government or of our Chinese bond market is relatively lower than the international market. As we all know, in the past 3 years or 5 years, the local default rate goes up in the recent years. But compared with the international market, the default rate is relatively lower than the international market. The credit rating between China and the international is quite different. So I would like to share with you from two aspects. The first aspect is that the culture or the economy is quite different from the international market. So as in China, a lot of the enterprises or the issuer of the corporate bond are state-owned enterprises, or some of them are government-owned enterprises. So the culture and the organism of the local corporate issuer of China is quite different from some of the Western economy. So that's one of the key point, the difference between China and US. So that will influence the credit rating logic. The first point. The second point is that the credit system of the Chinese credit agency and the international credit agency is quite different. In China, most of the issuers are rated above AA plus. But in the international market, BBB is in investment grade. So the whole grading system of the China and the international market is quite different. So that will make our international investor a little mixed, right? About the credit rating. They don't know how to match the local rating to the international rating. That's a little puzzle problem for them, I think.
First and foremost, we need to understand that those inflated credit rating in China are what we call domestic ratings. That is the parallel series to the global ratings, but they are not global ratings. In the past, the domestic scale ratings has been operating in China as parallel to the global market without causing that big a problem. And this is because the Chinese market were closed to the global investor in the past. And the domestic stakeholders are accustomed to those Chinese domestic credit ratings. But confusions started to rise over the past decades when the Chinese market started to open up. So you have global companies or government agencies issue the so-called panda bond in China. And the global investors started to buy and trade onshore bonds. So that's when those two rating scales started to meet up with each other. So after all, they have the same rating symbols. So sometimes that could cause a lot of confusion to the market participants from either sides. And somehow that creates, this negative impression that the Chinese domestic ratings are way too inflated. But in reality, it's just a different animal. And people have been making an apple to orange comparison. This is one of the research we did earlier this year. We have selected 132 issuers from the Chinese offshore US dollar bond market. So these are the names are carrying both domestic scale ratings and global ratings at the same time. You can see that their Chinese domestic ratings, which are the red bars on the left-hand side, are highly concentrated in the categories of AAA, AA+, and AA. And for the same rating targets, their global scale ratings, which are the blue bars, show a more reasonably shaped normal distribution. So now let's zoom into industry level. You can see that the rating gap is quite universal across industries, and I have highlighted some of the sectors that have the biggest rating gap. They are real estates, utilities, retail, and distributors. And we can take one more zoom into the specific names. So these are the selected names we have assigned a global rating to and who also carry a domestic rating. So you can better understand the gap on those names. I listed some of the key drivers of the rating gap and the differences in their application. Although I do think the Chinese domestic ratings are less than perfect, and we can easily pinpoint several issues, the timeliness and the credit differentiation, etc. But the global investor must realize a few things. Number one, these domestic ratings are just of a different rating scale than the one they used to in the global market. And number two, the domestic rating carry great data value. And number three, they should never confuse domestic ratings to the global ones when they make investment decisions. In recent years, we have been talking to global investors from many global regions: Hong Kong, Seoul, Singapore, Taipei, Jakarta, London, Frankfurt, Johannesburg. Like you said, the absence of credit rating, at least the absence of the credit rating they are familiar with in the global market, created quite some trouble for those global investors to invest onshore. So these difficulties could be on the PM level, which means that the portfolio manager needs to carry out the credit analysis all by themselves. And sometimes it is hard to do for the foreign names. And it could also be on the institutional level, which are related to the risk management and the regulatory capital function of those investors. Depends on their respective nature. So while my group company, CSCI Pengyuan, has been providing Chinese domestic rating over the past 27 years, My team at Pengyu International here in Hong Kong provides global ratings, which is the rating familiar to global investors, their institutions, their regulators. And other than being mandated by issuer to assign global ratings, we could also assign ratings upon global investors' demand in English, in global scale, with local touches. And this will be a useful service that will well support and supplement global investors' decision making.
I would like to analyze this question from two aspects. The first is that the difference between the trading platform. As to the international market or the international investors, usually we trade bond through Bloomberg or market access. Some kind of the platform we can get some price or can discuss with different counterparties. But in China, though the bond history of Chinese market is shorter than the international market, but from the beginning of the Chinese local bond market, we have established a very very good trading system, electronic trading system. So in the local bond market in China, usually our traders will do the trading of the bond trading through the CFAS or the Shanghai Stock Exchange or Shenzhen Stock Exchange for the OTC market or the exchange market. So the trading system or the trading platform is quite different between China and the globally. The second one I would like to say is that it's the information that you can get. As to the international market, if you want to buy a bond from one country or a US bond, usually we'll get some information from Bloomberg. And Bloomberg can provide international information from different countries, right? But as to the Chinese bond market, it's a little different. What's kind of the difference? The Chinese market is one of the biggest one in the global market. We are the number 2. As to the size, we are very big, right? We are the number 2 size. So that means we have different kinds of the issue in the Chinese market. And as we have mentioned before, the local issuer, some of the enterprises or some of the local government, that's quite different from the Western economy or Western company. It's quite different. So how can the investor get the local information of the local issuer, of the local Chinese issuer, to get more the first-hand information about different kinds of the issuer in China? That's a problem, I think, or it's a difference. Bloomberg can provide international information, but who can provide Chinese information to the international investor? Maybe one day from China, the China can have one platform can provide globally information from China about our local issuer to make more international investor to get more information from China, to make Chinese issuer more transparent, more globally to be known. Okay?
I think, as we all know, the Bloomberg has built a very robust trading structure for the US and the European OTC market. It's kind of the OQ function. They provide an OQ function to the major market makers, help them broadcast their pricings to the whole market. And another system is built by market access called like RFQ, request for quote. They provide bond buyers and sellers point-to-point pricing services, and this system is more suitable for corporate bonds. However, both of these methods don't work well in Chinese market. I think one of the major challenges for foreign investors, when they come to Chinese credit market is the low liquidity. especially buying liquidity. I think this is a major problem they will face. And in this market, in Chinese credit market, voice brokers still have a strong hold. If you want to find the price for a domestic Chinese credit bond, you pick up your phone and speak to the voice brokers, just like the old days. Yeah, if you want to find the information, research, and all the basic financial informations for domestic credit bonds, you go to terminals like Wind or DMI. Yeah, it's as simple as that. In China, there are about 8,000 bond issuers in total, and 70% of which are rated between AA and the AAA ratings. Among these 8,000 bond issuers, I think only approximately 700 to 800 have ever issued bonds in other currencies like USD or Euros. That means 90% of the Chinese bond issuers, they have never made their debut in the international market. So the foreign investors, they just simply are not familiar with them. I think if we look at the bond issuing data for 2020, let's say, for example, the 3-year duration bonds, those issuers with above AA ratings, they're issuing up to 8.5% of coupon rate, which is extremely high comparing with the corporate bond in other markets. And if we only look at those bonds issued, those bonds with AAA ratings, still the coupon rate is as high as I think 7.9%. I mean, the coupon rates vary from 3.3 to 7.9. We can almost come to the conclusion that the Chinese credit market, the ROI for Chinese credit market, is comparable to those markets in Thailand, Argentina, Malaysia, or even Philippines, way higher than United Kingdom, Japan, or Korea. Frankly speaking, I'm curious why foreign investors are not flocking to the Chinese credit market. One possibility that they don't know how to analyze the market. They don't know how to choose a Chinese credit bond. They don't understand the underlying risk. I think, to be honest, I have to say, don't just hesitate because it's a brand new and unknown market. You will miss some big opportunity. I think the underlying risk and the Chinese financial regulations and the infrastructure are slightly, somewhat different from Western market. However, if you dig deeper, if you look into it, the underlying risk, the underlying principles of these regulations, of these differences are not that complicated. So yeah, please just come to China. Yeah, as I mentioned before, the difference between Chinese financial regulations and the infrastructure are not as big as foreign investors think. What we're trying to do, what DMI aim to build is we are trying to bring these differences to light and transparently present them in a tone that foreign investors could easily understand. We provide various tools to foreign investors, help them better understand the Chinese credit market. We even provide the first-hand news and really fresh information from the local, the domestic Chinese credit community to our investors, help them grab the investment opportunities. We want to be a gateway for foreign investors into the Chinese credit market. That's what we're trying to do. I think one of the good opportunities is LGFVs, the local government financing vehicles. In China, there are about 3,000 LGFVs. They oversee the infrastructures for hundreds of cities across the whole nation. They are backed by the local government, so the market treats them one level higher than those same rated corporate bonds. At the moment, they still hold a record of zero default. looking ahead, in the next few years, the market is expecting some of the weak LGFVs to show some signs of default. However, I think in 1 or 2 years, they're still in the same zone. We provide some tools we call LGFV map. It's basically a map of China, and each region is color-coded. So the lighter the color, the lower the debt ratio or other financial ratios, which means a lower risk. You can basically zoom in on the province and look further into the cities in a district or a county to locate the LGFVs with the financial ratios matching the criteria. This is a very, very helpful tool to help you find the LGFVs you want. And also we create a dashboard to capture those discounted LGFV bonds. If you are a high yield bond player, this is something you don't want to miss. Last year, we track record, we monitored a lot of times the discounted LGFV bond trading opportunities. The ROI is up to 40% in a very short period, let's say in 2 or 3 months. This is mostly because of the liquidity, the banking liquidity issue happened last year, but this year we still monitor quite a few times. And aside from LGFVs, I think but we also have similar functionalities for real estate sector. So yeah, please give it a go. I think we will help you to dig some gold in the Chinese credit market.